Is Datadog a buy or a sell? Let's get started with the model. This is a large cap company, 52 billion market cap. They're trading at 153 a share, and they have 340 million shares outstanding. Datadog offers real-time monitoring of servers, databases, and other tools and services across the IT infrastructure. Their services help companies detect issues in their computer applications before it affects their users. It was founded in 2010, headquartered in New York City. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Really nice free cash flow growth from $250 million, up 41% the next year, up 69% the following year, up to $600 million, up another 23% in the trailing 12 months. Really good margins. They convert 29% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was negative in 21 and 22, a small positive in 2023, up nearly 300% in the trailing 12 months to almost $200 million. Revenue is a sales for the company, and that more than doubled from 2021 to 2023, $1 billion to $2.1 billion. Up another 19% in the trailing 12 months to $2.5 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value total cash flows past year 4, that's $27 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $23 billion. We divide that by 340 million shares. And we get a calculated stock price of $69. They're trading at 153, so they're trading at a 123% premium. It's a sell according to the model. Do you think it's a buy or a sell? Let me know in the comments. There are 101 companies in the same industry as Datadog, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx, only $90 million, still higher than the median average. A good debt to equity ratio, 0.4. For every dollar of equity, only 40 cents of debt. They don't pay a dividend. They generate $735 million of free cash flow, which is more than FICO, and FICO is larger in terms of market cap. They rank 8th in market cap at $52 billion. Salesforce is number 1. All their price multiples are worse than median. Look at that PE, 271. That's because their net income is so low, but as they scale and grow, that will change. And the reason people are buying the stock at these levels is because of their 5-year annual revenue growth rate. It's 52%, the highest on this list. They're trading about 10% below their 52-week high. So if you really like this stock, you should buy it now because it may break through its 52-week high soon. If you put $10,000 into this company when they started trading, you'd be real happy at $42,000 today, a 32% annual return, a 320% total return. To summarize, I have them trading at a 123% premium, ranking 5 out of 10. I'm not too sure about this company. I definitely have to do more research. I probably wouldn't buy it short term, 5 out of 10. Long term, I'm more likely to buy it 7 out of 10. Their ratios are real weak. They seem real overvalued according to them, 2 out of 10. But their financials are great, 9 out of 10. Their free cash flow is up almost 200% since 2021. Revenue up almost 150% in that same time frame. Let's take a look at their income statement. Here's the third quarter of 24, third quarter of 23. Big revenue jump from $550 million to $690 million. That's an increase of almost 40% in just one quarter. Let's see if they give a breakdown of the revenue. Of the $700 million of revenue, $480 million in North America, $200 million outside of North America. Of the $484 million of revenue, $462 million is in the US. The rest is probably from Canada, maybe Mexico. Let's go back to the income statement. Cost of revenue, all the expenses directly tied to generating the revenue, $140 million. Gross profit, $550 million, up from $444 million. Then you have operating expenses, R&D, $290 million, sales and marketing, $190 million, G&A, $52 million. So total operating expenses are lower than their gross profit. So they do have positive operating income of $20 million. Last year, they had an operating loss of $4 million. They spend $1.6 million of interest on their debt. They receive $37 million of interest income. They must have a lot of cash on their balance sheet. Pre-tax income 56 million, 4.4 million of taxes, so their net income 52 million. EPS more than doubled from 7 cents to 15 cents. And they are adding shares. Last year they had 326 million, now they have 338 million. So they added about 12 million shares. Let's look at the balance sheet. Current assets 3.8 billion, current liabilities 1.8 billion. So current ratio a 2. They have over 3 billion of cash and marketable securities. That's why they have so much interest income on their income statement. $500 million of accounts receivables. This is how much money other companies owe them when they sell on credit. Looks like they do a bunch of acquisitions. They have 350 million of goodwill. So their total assets 4.6 billion, up from 3.9 billion. Total liabilities 2 billion. Their biggest liability is deferred revenue. This is when they receive payment for a product or service before it's delivered. So it's carried on the balance sheet as a liability. When they provide the product or service, then they'll remove the liability and book the revenue on the income statement. They have 744 million of convertible senior notes. That's due within 12 months. This is their statement of cash flows. So for the trailing 9 months, operating cash flow of 600 million. So in order to pay those convertible notes, they're probably going to have to take on more debt because I don't think they have enough cash to do it. The hope is the stock price goes up a lot and the holder of the convertible notes converts the debt to equity. They talk about the convertible notes right here. In June 2020, they issued 748 million of notes at an interest rate of 1/8 of 1%, so really low interest rate. The conversion price is $92.30. So it sounds pretty likely that the notes will get converted to equity and they don't have to pay the debt down, since the stock price is well over $92 right now. Assets minus liabilities equals equity, 2.6 billion of equity. They raised 2.6 billion from selling stock, and they lost 16 million from running their business. But it improved a lot. At the end of 2023, their accumulated deficit was 150 million. Now it's down to 15 million. So by next year, they should have positive retained earnings. Let's look at a statement of cash flows. The first section is operating cash flow. That was 600 million. The way you calculate that, you start with your net income, 138 million. Then you add back things like stock-based compensation, 400 million. That's an expense that brings down your net income, but it's a non-cash item, so we add it back here. That's the main reason they generate a lot of cash flow, even though their income statement doesn't look so good. In their investing section, they spent 27 million on PP&E, 44 million on capitalized software. In their financing section, they received 23 million from selling stock to their employees. Let's look at the stock on Simply Wall Street. Its last price 153, 53 billion market cap. It's not doing well in the past week, down 9%, but up 25% in the past year. It looks like the stock started trading at the end of 2019 around $30 a share. That was the low point. So if you bought it at IPO, you probably made money, unless you sold within the first month or two. But if you held out at least a few months, you had a good return. At the peak, it was 191, the stock price. That was at the end of 2021. Then by April 2023, it got to the low 60s. Now it's up about 150% since that point. Simply Wall Street's valuation is 185. They say the stock is 18% undervalued. 41 analysts priced this stock at 156, pretty much where they're trading at. Look how much their revenue has grown since 2017. It was 100 million, and it grew 500% by 2020 to 600 million, and it just keeps going up. A lot of this is through acquisition. It hit $1 billion in 2021. It hit $2 billion for the first time in September 2023, and now it's at $2.5 billion. Pretty impressive growth. The CEO's salary was only $300,000 in 2018. Now it's $400,000. Total compensation $12 million. Tenure 14 years. In the past year, everybody's selling the stock. Nobody's buying it. Look at all these sells at 150, 120, 100, 120 again, 130, 130. So about 600,000 shares were sold within the last year. Nobody bought it on the inside. 75% of the company is owned by institutions, 17% by the general public, and 8% by insiders. Vanguard owns 9% of the stock. That's the biggest shareholder. T. Rowe Price, Geode, JP Morgan, UBS, and the CEO of one of the companies Datadog acquired owns 0.7%. Their employee count has gone up a lot from 1,000 to 5,200. And the ticker trades on the NASDAQ, Mexican Bolsa, Bursa Stuttgart, London Stock Exchange, Deutsche Börse, Xetra, Wiener Börse, and Sao Paulo Bolsa. So if you want to get a discounted cash flow model, click on the video in the top right corner. Thanks for watching.